Did you know that sometimes what separates very successful investors versus those that are less successful is their habits, and some have more highly effective habits. And we're going to talk about 9 of those highly effective habits to help you become a better investor coming up. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. You ever read an article like online or something like that and you're thinking, I wonder if this applies to me, right? And I did this. I came across an article called The 7 Habits of Highly Effective Investors. So these are, you can see the title here, These Are the Basics of Running Your Financial Life by Susan Woolley and Bloomberg. And I have all the links to the actual full article in the description below. And I thought it was an interesting article. I want to share some things, some of the bullet points from that, and kind of look at these 7 things. But I also thought of 2 extra ones because I thought number 8 and number 9 are very important that weren't covered in the article. In fact, in the article, the number 5 one, I don't know if I totally agree with, but number 9 is maybe the best one. So stick around to that. So let's look at some of these bullet points as far as what can make a highly effective investor. So the first one is save early and automatically, right? You're saving early and automatically. And so what we mean by that is the earlier you start saving, really the earlier you start saving and then investing and getting better returns or better return on your money, the longer the time that money can grow and grow on top of each other, kind of like you think of the concept of compounding or compound interest. So the younger you start as far as your investing career, the longer time you have for things to grow. So that's a really, really good thing. Now, here's the thing. Every investor thinks, if only I started sooner enough. Even I'm like that, and I started pretty early. Be like, gosh, if only I started sooner, I'd have so much more. And that's true, but don't beat yourself up on that because everybody thinks that. I have a student from India who was in one of my courses, in my Stock Master course, and he is 15 years old. And I bet he's thinking like, boy, if I only started when I was 12. If I was 12, think where I'd be, right? So everybody thinks that way. If you are starting a little bit later in investing, and a lot of people do, you might just need to put in even more, save even more money and put investing even more, possibly even take on a little bit more risk to still reach those goals. So those are things that we teach about in the courses and stuff, but that's something to consider. So if you can start saving now and investing now and investing early, that's really important. And then the other part of this is automatically. So you don't have to think about it. You don't have to think about, well, should I buy something or whatever? The more you can just have a lot of things automated. So if you have a payroll deduction at work where you can take that payroll deduction and then buy, mutual funds, exchange trade funds, maybe some stocks or whatever it might be, directly deducted from your paycheck, that's a really great way to automate that. In the United States, we would call that like a 401k plan where it's automatic deductions to get some tax benefits. Other countries might have similar plans, so check out where you live as far as if you have an automatic deduction plan. But if you don't have that or want to supplement that, you can set up like an online brokerage account or things where you can link your bank account and then like with a mutual fund company or an online brokerage account, and they'll automatically pull, let's say monthly out of your savings and automatically invest that. So the less you have to think about that, unless you're a real active trader, and that's okay if you're an active trader, but if you want to be more buy and hold and make it a little bit more automated, that's a great way to go, is so you don't have to touch it and think about it. Because one of the downsides of it, if it's not automated, is like when the market's, let's say, crashing or there's troubles in the market, like during the COVID pandemic, the early days when the stock market's going down, you might think, I don't want to invest because it's going down. Or maybe it's at a peak and like, I don't want to invest because it's too high. To automate that, smooths that all out and takes out that behavioral finance, that thinking where you overthink it, so to speak. So I like this one. Save early and automatically, I think is a good one. And certainly it's always applied to me, and I'm a strong believer in it, and I think you should embrace it too as well, or I would recommend it. Number 2, expect financial emergencies. Well, the article that gets into this too is setting up an emergency fund, right? So you never know if there's going to be an unexpected hospital bill or a car repair or something. You want to have like 3 to maybe 6 months worth of your income, your salary, whatever that is, set aside so you're ready to handle an unexpected bill. Maybe it's a job loss. Maybe you need a little bit more. If you're in a job that's less secure, you might want to have 6 to 8 months of savings, just safe savings and like a cash or checking account, just low interest rate. I get it, but it's just there to help with those emergencies. So think about that as far as your budget and your spending, but to have an emergency account is a good idea too. Expect financial emergencies. So far they're both pretty good. Let's see what the other ones are. Number 3, Set an asset allocation and diversify. So what this is talking about is your portfolio. What are the different types of investments you have? Maybe you have some stocks, maybe some bonds, some cash or CDs, maybe some cryptocurrency, maybe some foreign exchange stuff, maybe some gold. I mean, a lot of different asset classes you can invest in. And then within an asset class, you can diversify or have different holdings within a class of assets. So let's say the stock market, for example, you might have some big or large cap stocks, some medium stocks, and some small or small cap stocks, maybe some stocks from outside your country or international stocks in a variety of holdings like individual stocks or mutual funds and ETFs that have in combination to give you that variety, that diversification. By doing that, you don't put everything on one stock, for example, or one cryptocurrency because the volatility up and down is so high. So that's a good idea as far as having an asset allocation, and you can change and rebalance that as you go. So that's number 3. Number 4, keep fees low. I'm a big believer in keeping fees low, especially if you're buying like mutual funds, exchange traded funds, those type of things where they might have an annual expense ratio or fee. We have courses that go into great detail on that, of course, but just think about when you're buying something that the fees are low. You're trying to always reduce your fees. And one of the nice things is we live kind of in a golden age that's really changing here, where there's a lot of financial technology or fintech and other things to help drive prices down. There's a lot of competition, so what we're paying on our mutual funds and exchange traded funds are a lot lower than they were, let's say, 5-10 years ago. We have where you can buy and sell stocks, for basically no trading fees. So there's different ways that you can do or be involved with investing and keep your fees low. So start looking at your fees and see, well, am I getting a good deal on that investment? All right, so number 5, you had some problems with number 5, so let's take a look at number 5. So number 5 from that article, The 7 Habits of Highly Effective Investors, was use an advisor who is a fiduciary. Now, one of the big problems I had with the article, and if you click the link to go to the article, when you read that short little section, she doesn't even talk about advisors or fiduciaries or anything really that in good detail. It doesn't even define what a fiduciary is. Don't worry, I will in a moment here. And so I really had a problem with the article with that. In addition, not everybody needs an advisor. Not everybody needs a financial advisor. You can educate yourself and do your investing like DIY, do-it-yourself investing, and many people do, and many people are very successful with that. And if you are looking at an advisor, make sure again looking at keep your fees low, what your advisor might charge, and then that you have that trust factor with an advisor that you trust them. So whether you have an advisor or not, I don't think that's a highly effective habit. It's just whether you choose to go one path or another. I mean, this advisor here in the image, she seems nice. She's using a calculator and all that, so obviously she's very smart, right? She's using a calculator. Great job. And then the other thing is, what is a fiduciary? And that's referring to advisors. It's a term, and not every country might use this term, by the way, but many countries do, where a fiduciary is basically a designation for an advisor where they're saying, I'm a fiduciary, and by that means I'm going to put my client's welfare above my own. Well, that makes total sense. Who wants to work with an advisor who doesn't do that? Well, actually, one of the problems is still, but less prevalent because you do have fiduciaries, is where advisors might recommend certain investments because they get paid more on it. A certain mutual fund that they might recommend because they get paid a little bit more, or an annuity, which is an ongoing stream of income. It's actually more of an insurance product, and annuities have a bad rap as far as being highly expensive in terms of fees. And part of that fees is paying the advisor to recommend and basically sell them. They're more salespeople at that aspect. So fiduciary is saying, well, they're going to put your interests above theirs. And really the way they do it from a financial standpoint, beyond just trust, which is important, is what they do is they charge as a percentage of your holdings. So if you've got whatever, $100,000, $1 million, $5,000, whatever it is, invested with the advisor, they might take a percentage, like 1 to 2% of your overall holdings. So if your performance goes up, they're going to get a little slice or bigger slice of the pie too. But it doesn't matter to them what they recommend, because they're not paid on that. They're paid on your overall holdings with them. Or maybe it's a flat fee where if they do a big financial analysis for you, they might charge you a flat amount like $500, $1,000 to do an in-depth analysis of your holdings, for example. So different ways they can structure that fee thing, and that ties back into fiduciary. But again, you might not even need an advisor. So 5, I'm not so sure with. 3 more left, 6, 7, 8, 9. Well, that's 4. Good thing I'm not involved with math, right? Number 6 is saving, and really coming into spend less than you earn. And the idea behind that, obviously, if you can spend less than you earn, then you're not going into debt, you're not running up credit card debt or any other type of debt, you're spending less than you earn, and then you can take that money and then invest it, right? And that's where the magic happens, that's where the growth happens. If you can't save, if you can't do that, then you're not going to be able to be successful with investing. The more you can save, the better off you'll be. And you'll be happier too. Famous quote from Charles Dickens, the famous author, said, annual income 20 pounds, annual expenditure 19 and 6, result happiness. You're spending less than you earn. Annual income 20 pounds, annual expenditure 20 pounds, ought and 6, result misery, because you're spending more than you earn. So that's an old quote there as far as, around happiness. But it's kind of true too, because that helps fund, again, your investments. And one thing that's been helped me in my career, my investing career, and in my business career when I was doing that, before I started doing investing education, is whenever I would get a promotion or a raise, or maybe I got a bonus or something, whatever it might be, I took almost all that money and then I invested it, because I maintained my lifestyle. We were always, my wife and I, Mrs. B, we always lived below our means, so we could invest more, and thus, in the end, we're able to retire early and have financial independence and all the great stuff that comes with that. I really want that for you, of course. That's why I do what I do, because I enjoy talking about investing, but I want to help people that way. And that's one of the great ways to do it, is a lot of people, when they get, let's say, a bonus, they're like, great, I got a bonus. Now I'm going to go buy a boat or a fancy car. I'm going to spend it. And maybe there's some things you want to spend a portion of it on, or all of it on, that might be a life experience, like a trip you've dreamed of or whatever. That's kind of investing in yourself versus, trying to, and that's okay, versus something where you want to put at least some of that money aside, and so you can invest it and have that money grow again over time. Let's look at number 7. And number 7 is maximize employee benefits. All right, so that's like if your company, let's say, provides some maybe matching or some incentive to help you with your investing. Again, in the United States, with some of our 401k plans, you might have the employer who helps manage the plan for you, or works with an advisor to do that, is they might match whatever you contribute up to a certain percentage, maybe let's say like 3%. So if I put in 3% of my salary, my pay, into this plan, this company organized plan, and the company says, well, we'll match up to that 3%, that's free money. They're just like, here you go. So you should at least try to strive to do that if you have that type of plan at your work. And if you're not sure, go check out and see, do we have an investing and saving plan at work, and how does it work, and is there any type of matching or a benefit around that? So that's where number 7, as far as maximizing those employee benefits, at least get to that, because that's like free money. So take a look at that when you're looking at your own situation. All right, so those were the 7 from the article. It was pretty good. 5, I'm not so sure about. But let's say I got 2 more bonus ones for you here to take a look at. And number 8 is know what you are investing in. You'd be surprised that as you start adding investments, particularly like mutual funds and exchange traded funds where they have a lot of holdings underneath them, where you might not understand totally what you're invested in. Or I've known people who are like, I know I bought some stuff through work, but it was years ago, and I automatically invest, and I can't really remember what I did. Or I've been collecting all sorts of different investments along the way, and some of the stocks I might know, and maybe I got a cryptocurrency I know about, but gosh, what's in that one exchange trade fund I bought, or those 3 mutual funds? So periodically, just take a look at your investments, maybe monthly, maybe every 6 months, maybe quarterly, whatever. Certainly on a yearly basis, you want to at least rebalance, maybe every 6 months, to really, really look closer at it. And even if you're more of a buy and hold investor, every 6 months to a year, you want to start looking at that closer, I would say. And just know what you're invested in. And you'd be surprised if you're using this as a checklist, and it's a good checklist to kind of go through in your mind mentally, like, do I know what I'm invested in? And you might say, sure I do. And then if you think a little bit harder, you might be like, I'm not so sure. So if you think about a mutual fund, if I was to ask you, all right, what's the top 10 holdings in that mutual fund? You might be like, I don't, what? So it's okay. You don't have to know that off the top of your head, but you'd want to know at least that the mutual fund, what it's invested in, what type of investments, is it large cap stocks, is it technology, whatever it is, that you understand that. And so you know what you're invested in. And the last one here, number 9, which I think is very, very important, and that is to keep educating yourself, Okay, that's pretty obvious, right? I'm in the, I guess, the education business with my YouTube videos and with my courses that I sell online. I have some free courses too. So in the description below, there's a free course, there's paid courses, there's a lot of different options for you. Also, on the channel homepage, you can look at all sorts of other videos. So I encourage you to check that out and check out another video as well too. But I think that's so vitally important. I know when I started investing, nobody's born with investing knowledge. You don't come, you're not in the crib or, as a third grader, knowing about investing. Even if you graduate with a finance degree, or like me, where I graduate with a master's degree, an MBA, you don't really teach you the practical aspects of investing. So you got to kind of educate yourself and look for those opportunities, because things are changing all the time. And the more you can educate yourself and become a better investor, the better that's going to serve you in the long run, in terms of being a better investor. So the fact that you're watching this video and that you watched this far, I have really high hopes for you, because you're really educating yourself. So to wrap up this nice video here, think of these 9 different things and kind of grade yourself and say, how am I doing on these 9 things? Am I educating myself? Am I doing these different things? Do I have an automatic thing set up? Am I saving early? All that kind of stuff. And think through that and see how it applies to you. Because in the end, that's all that matters, is how it applies to you. Well, thanks for checking out the video. Again, check out some other videos that we have, and I wish you all the best of luck.